I'm not against credit, but I'm against dishonest credit. You could rephrase the question and say, well, it's 3,300 now. What makes it go to 10,000? What makes it go to 20,000? I don't think 10,000 or 20,000, I think there's that much of a difference, because once it goes to 10, it'll go to 20, it'll go to 50, it'll go to 100, and then it'll just go to infinity. I mean, the final stages of these processes are very quick. And they always are. What causes that? I think the next round of QE, followed by, the last round of QE started in 2019. It really took off. It's September 2019 it started. Then it took off around COVID, which might have been an excuse to add more money. It might have been planned. It might not have been planned. It might have been something in the middle. I don't really know. But I think we're going to see something similar at the beginning of another round of QE, which I think will bring gold up to maybe 4,000, 5,000.
Current market expectations suggest 1 to 2 rate cuts in late 2025, according to the CME FedWatch Tool, potentially providing additional tailwinds for gold prices. According to Bloomberg Commodity Research, May 2025, gold's 12-month rolling correlation with CPI has averaged 0.65 since 2020, demonstrating its effectiveness as an inflation protection tool. Renowned investor Rafi Farber believes renewed quantitative easing triggers an unstoppable crisis. This could push gold to $10,000 or beyond, potentially leading to hyperinflation. Looking ahead, Farber explains that mainstream stock markets such as the S&P 500 are overvalued illusions when measured against gold. He believes a major shift could repeat, with gold again vastly outperforming stocks. When the current counter-trend move ends, gold may experience significant price appreciation. Historical precedents suggest that gold could reach $5,000 or more when stocks eventually peak and the ratio plunges to new lows, potentially reaching a historic gold milestone in the process. Concurrently, Farber warns the dollar index can't swing too far without disrupting global trade. Whether the Fed tightens or prints, he says, the system collapses either way. Gold will no longer be priced in dollars. Instead, gold will be priced in the dollar. This shift would trigger a complete reset of the fiat and banking system. The recent weakness in the dollar stems from Trump's mixed signals to investors about the dollar's role as the world's reserve currency. While gold has been an effective hedge against inflation, it is unlikely to replace the dollar as a global reserve currency due to challenges with transportation, storage, liquidity, and supply. From a technical standpoint, Farber emphasizes that as trust in the dollar collapses, ordinary people will turn to silver. He predicts that silver will return to its historical gold ratio of 15 to 1, rising 5 times faster than gold in a monetary crisis. Before we dive into Rafi Farber's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
It is, in a sense, because the ratio of gold to the S&P 500 is lower than it was in 1971. So the real value of stocks is lower. Like if you took 10 ounces of gold and stuck it in your mattress in 1971, you'd have more purchasing power now than if you took the S&P 500 in 1971 and stuck it in your portfolio. You'd have more purchasing power with gold, which means the entire rise in the S&P 500 has been a chimera. It's been an illusion. It's not even real. In 1980, what am I looking for in terms of price signals? In 1980, I think the S&P 500 was the high for the ratio of gold to S&P was, I think, 0.4 or 0.53, if I remember the number correctly. I don't remember exactly what it is. But whatever it was, it's like 78 times what it is now. So, but that only took that from 1971 to 1980, and really from like 1976 to 1980, in those 4 years, that's when that huge spike happened. So that's what I'm looking for, a rise of about 79 times in the value of gold versus the value of S&P, which means that everyone's purchasing power who has mainstream stocks will be cut into 80 pieces and they'll get to keep one, whereas everyone who has gold right now will suck in all that purchasing power, and that will be the end game. And silver even farther than that. I think it was silver that was set. That was 80 times. I think it was gold that was maybe 15 or 20. Sorry, I'm mixing up the metals. But in terms of the Dixie, truth is I don't even follow it because the Dixie, the dollar index can't swing too far in either direction because it disturbs trade relationships. And once you disturb trade relationships too much, then exporters from some countries get upset and importers from other countries get upset, and they have all the political power because they control the economic spigots of the country, what's imported, what's exported. So when the Dixie gets too weak, the Fed has to slam on the brakes, which they'll have to do. But if they do that, they cause a banking crisis. So we're getting into that territory where they have to pick if they want to maintain the dollar strength, do they want the banks to survive? And once we hit a corner there, it's just going to explode. What's priced in terms of gold? Why are people valuing it at 3,300?
Yeah.
I don't know. Why is it 3,300 and not 3,500 or not 3,800? I don't know. I just know that it is money, and that it's not dollar bidding on gold. It's not that people have dollars and they're saying, well, how many dollars am I willing to offer for this amount of gold? And then they decide. It's gold. It's gold bids on the dollar. Gold is the money. It decides how many ounces of gold people want to give up in order to have some dollars that they might need for whatever purpose. But once gold is no longer exchangeable for dollars on the futures market or in a coin shop, then everything goes to hell. Then everything's over. There's no more dollar. There's no more banks. There's no more anything. Then what happens? Then you have to start over from the beginning with whatever real assets you have, and then start building an economy from there. And then from maybe a year or two later, you can restart a credit system, and hopefully this time it'll be an honest credit system. I'm not against credit, but I'm against dishonest credit. You could rephrase the question and say, well, it's 3,300 now. What makes it go to 10,000? What makes it go to 20,000? I don't think 10,000 or 20,000, I think there's that much of a difference, because once it goes to 10, it'll go to 20, it'll go to 50, it'll go to 100, and then it'll just go to infinity. I mean, the final stages of these processes are very quick, and they always are. What causes that? I think the next round of QE, followed by the last round of QE started in 2019. It really took off. It's September 2019 it started, and it took off around COVID, which might have been an excuse to add more money. It might have been planned. It might not have been planned. It might have been something in the middle. I don't really know. But I think we're going to see something similar at the beginning of another round of QE, which I think will bring gold up to maybe 4,000, 5,000, and then banks will start getting in trouble, and they'll just start printing more and more and more, and then it'll just start going vertical, and that'll be the end of the story. Silver is the public's money. Okay, so gold functions as money for banks. They don't have any in their vaults, except for maybe JP Morgan or something. But what they have is futures contracts, which are theoretically connected to the physical supply. Banks don't deal with silver. Central banks don't have silver. It's too bulky. Silver is the people's money. So when people start to figure out that their dollars are losing purchasing power, they can't necessarily go to gold. So they go to silver, which means that the monetary demand for silver becomes infinite. It becomes for people need food, they need water, they need energy. But in order to acquire all those things, you need money, or else it can't be distributed. So famines, for example, are usually not due to a shortage of food. They're due to a shortage of money, because if you don't have money, you can't distribute the food. You can't tell where the demand is, so it just like rots on trains. If you read the book Mao's Great Famine, which is the greatest famine in the world from 1958 to 1962, it wasn't because of a lack of food. It was because the money didn't work. And and Mao's whole regime was controlling the entire, not because there was hyperinflation, but because monetary exchange was outlawed, and like everything was in the hands of the Communist Party of Mao to decide which food was going where, and they couldn't decide because they didn't know. So then all the food rotted. So that's what happens when you don't have money. When the dollar no longer works, everybody goes to silver, and that reestablishes the historical monetary ratio of around 15 to 1 of gold to silver, which is where it was before 1873, when the dollar was a derivative of silver and gold by metallic standard. So we'll go back there. We'll go back to 15 to 1. The industrial side is important. It's not as important as the monetary side, but it's important because silver is a byproduct of mining. It's not really a primary product. Like the silver supply that we have is due to mostly, let's say, copper miners or lead miners or zinc miners. And then they mine a lot of zinc or a lot of copper, a lot of lead. Not that, maybe 5-10% silver. And so they sell the silver no matter what the price is. Since the price is so low, there's not enough silver being mined as a secondary product to satisfy all the industrial demand. So what will end up happening is that we're seeing silver inventories get lower and lower and lower as industrial demand takes up the silver inventories that are already above ground. And once those are zero, then you have a slingshot move. And what I think is going to happen is that's going to contribute to the rise in the price of silver. And the rise in the price of silver means, by definition, the destruction of the price of the dollar relative to silver, since the dollar is a silver derivative. It was in 1873, therefore it still is now, not statutorily. I understand that it's not a statutory derivative of silver, but because the dollar was born out of silver, it still is a silver derivative. So if the price of silver is triggered to rise very quickly because the inventories that are being sucked out of these big safes or these big vaults, if they go to zero because of industrial demand, then that triggers the hyperinflation, the same hyperinflation that we're talking about from a monetary perspective, from an industrial perspective also. These are all different ways to look at what's happening, different angles at the same result here. So when that happens, it could be a catalyst, it could be a secondary cause, but it's going to happen. And then silver is going to go to 15 to 1. I think it's about 90, 95 to 1 now. So silver should rise about 5 times faster than gold in dollar terms. And that's where most of the gains are going to be. And once it hits 15 to 1, buy whatever you can with your silver coins.
In the interview, Rafi Farber argues that the term world reserve currency is merely the most widely used credit unit, not a fixed role. According to him, the dollar gained that status after World War II, allowing the U.S. to export debt and import goods. This brought decades of prosperity, but when the trade deficit reverses, inflation and economic pain will follow. It is currently down 7.3% from its 2025 peak, which occurred on January 13th. The dollar's drop has raised concerns because it coincided with a spike in U.S. interest rates, an unusual event. While reflecting on major points, Farber notes that the Treasury's $300 billion Fed account can drain bank reserves, thereby pulling liquidity from the system. If reserves fall too low, the credit-based dollar risks collapse. In that scenario, only real money, gold, and silver remain. Let's get back to the interview.
The problem with the term world reserve currency is that people start getting confused, and they think that there's a category called world reserve currency, and it's like an empty box, and then each country gets to put their currency in it for a certain amount of time, and then everyone was like, okay, you get the box now, and then 200 years later somebody else gets the box. That's not how it is. It's not like a thing called world reserve currency that has to exist. Right? Just like there's no such thing as a single money. There's no one thing that's a money versus everything else that's not a money. It's not. It's just as money is not an artificial category that people just decide on and then vote on in a big stadium. It's a continuum. So world reserve currency just means the credit unit that most people use. The credit unit that most people use in the world is the dollar, and that's just an accident of history that the United States conquered all of the world after World War II. And basically annexed the entire planet by giving dollar units to all the banks of the countries that it conquered, including the Soviet Union. Right, the Soviet Union started using dollars, and then because they didn't have really an economic system, they're communists, so their currency doesn't work. So they have to base their currency on a currency that's actually functional. Which was based on gold back in the 1930s and 40s until 1971. And even now it still is. It's just not convertible. So world reserve currency just means it happens to be through historical accident that America took over the world. And on that opportunity, once they won World War II, they went to all the financial centers of the world and said, look, here, give us your gold. Even before World War II, they did this. They give us your gold. We'll store it here in New York so the Nazis don't, invade your country and take it. And then we'll give you dollars and you can use those. So everybody has dollars. And what does that enable? That enables like a huge inflationary pot. If you have more people taking your inflation through trade deficits, like everyone complains about the trade deficit. Trump complains about a trade deficit, but a trade deficit is the only thing that is keeping the dollar functional. Because what is a trade deficit? It's when America exports a whole bunch of dollars, which are backed by debt, and they get them out of the country, and in exchange for all those dollars, they get stuff, right? So you're importing more stuff and you're exporting crap. So that's great. If I had a printing press and I could just print out pieces of paper and import a whole bunch of stuff into my house and have a trade deficit, I'd look really freaking rich. That'll be great. But then eventually people would call in my debt, and then I wouldn't be able to pay them. So they'd take all my stuff from me because I couldn't pay. So that's what's going to happen. So the world reserve currency, it just increases the inflationary pot that America can skim off of, and that makes it a lot longer lasting. But it also makes the eventual, knocking on the door with the repo guy coming and saying, "Give me your stuff." It makes it all that much bigger in the end. So yeah, we just experienced the biggest several decades, let's say 50 years of humongous, insane prosperity for all Americans who basically didn't have to do anything in order to survive. And now once this is over, the trade deficits are going to reverse. They're going to become humongous trade surpluses, which are going to bring all the dollars back into America, yay, in exchange for all the stuff that they imported. And then everyone's going to be poor, and they're going to have to figure out how to work again or die. In the scheme of things, well, I can just tell you what the numbers are, and then you can make your own calculations. There's $300 billion left in the Treasury's bank account at the Fed. They could theoretically run that down to near zero and then start raising debt and then sucking out of bank reserves, or they could start sucking out of bank reserves immediately, which is, I think, what they will do. So, when they start taking money out of bank reserves and putting it in their bank account, once the money is in their bank account at the Federal Reserve, they have a checking account, just like everybody has a checking account. But it's a special checking account. It's a checking account that is not counted as part of the money supply. Our checking account, my checking account at whatever bank, Bank of America, Wells Fargo, whatever, your checking account, right? Your bank can lend out those deposits because it's a fractional reserve. It's not even a fractional reserve bank anymore. It's a zero reserve bank because the reserve requirements are zero. So they can take your money and they can lend it out, and hopefully they didn't lend out everything. So when you want to take cash out of your account, then they just, take it from somebody else, give it to you, and then it's all a big mess. But in their special checking account at the Federal Reserve, nobody can lend out their deposits. It's illegal. It's not part of the money supply. So once they suck the bank reserves out, nobody can use them. Not a single bank, nobody. So that becomes out of the money supply, outside of it. No more in the money supply. So it'll go back into the money supply, yes, when they spend it and give it to another bank to buy bombs or to buy welfare or whatever the hell they're doing, to pay Social Security checks. Who cares? So when but in the meantime, when the money is in their checking account and not at another bank, it can't be used. So if you look at the size of the Treasury's banking account, I think it went up to like $800 billion or even over $1 trillion in 2020. And it's at 300 billion. So if they raise it to let's say 800 billion, 700 billion, that's 400 billion less reserves than there are now. And there's 3.3 trillion. So you take away 400 billion from that, you have 2.9 trillion in reserves, supporting 2.9 trillion in repos. That's getting pretty close. That there's not enough. So that's why I say weeks. I don't know how many weeks. It doesn't matter. There are some banks that don't have cash, and there are some banks like JP Morgan that have a whole bunch of cash. So let's say JP Morgan lends out its cash to these other banks so that their clients can borrow it through the repo market and then use it to fund Treasury futures trades. I'm not talking about monetizing any kind of debt, but in order for the dollar supply to be added to, how it's done is that the Fed buys treasuries, because they could buy anything. They could buy my chair. They could buy, Harry Potter books. It doesn't matter. As long as those dollars are added to the system, it doesn't matter what they buy. Then the dollar becomes backed. The word we use is backed by whatever assets they buy. If they buy my table, if they buy my couch, then the dollars are backed by the value of my table and the value of my couch. It just so happens that when they buy treasuries, the dollar becomes backed by the asset that they're buying. Like, the dollar is a liability unit. A liability unit has an asset on the other side. The asset on the other side is mostly treasury debt. But treasury debt is the promise to pay those same liability units in a circle. And so you have an inflationary loop that, if it doesn't keep expanding, it collapses in on itself like a black hole. So you have the situation we're in, I guess, astronomically, is a neutron star, where you have a star that's just dense enough to maintain its volume without collapsing into nothingness. But if it gets any more dense, it just collapses in on itself, and there's a black hole, and then it disappears, and you have an infinite density unit called singularity, and that's where we're headed. So what happens after the singularity? The dollar goes away, nobody uses it anymore, and we have to go back to what money actually is, which is gold and silver. Credit goes away. When credit goes away, money goes higher. The dollar is credit. It's not money.
Leading financial institutions have issued generally bullish projections for gold in 2025, though with varying degrees of optimism. Do you think gold could reach $10,000 or beyond in the next bull run? And what implications would this have for the global economy? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.